Hello students, today we are learning about pricing practice. Price is the value that is attached by a company to a product. It determines a lot of factors for the company. Organizations determine their prices which are consistent with their offerings, promotions and distribution strategies. The objectives of the pricing policy are as seen on the screen. Some organizations try to set their prices in a way that allows them to capture a larger share of the sales in their industries. Many companies believe capturing a maximum amount of market share is downright necessary for their survival. ROI or return on investment is the amount of profit an organization hopes to make given the amount of assets or money it has tied up in a product. ROI is a common pricing objective for many firms. Many companies set their prices to increase their revenues as much as possible relative to their cost. However, larger revenues do not necessarily translate into higher profits. To maximize its profits, a company must also focus on cutting costs or implementing programs to encourage customer loyalty. The factors considered while fixing a price are cost of production, may it be fixed or variable cost. All of it put together is considered for pricing the product. Elasticity of demand, if the product is elastic or inelastic in its demand, the price is determined by the elasticity of demand. The market structure also helps determining the price, whether the company is operating in a monopolistic competition or in an oligopoly market or in a monopoly. The factors that would be considered for pricing here will differ according to the market structure that the company is operating in. Objectives of the firms, namely sales maximization, revenue maximization, or market share maximization, will help determine what should be the price or the level of pricing for the product. Government's control or interference is as in the taxes and the subsidies that are given by the government will also affect the pricing of the product. Types of pricing policy. Price discrimination. This is a process when the same product is sold to various customers at various prices. There are 3 degrees of price discrimination. The first degree price discrimination takes place where each customer can be charged a different price for a good or service. It is usually possible in the case of services which cannot be transferred from one person to another. Doctor's services can be cited as an example here. Second, the second degree price discrimination. Here the monopolist charges each consumer the highest price he is willing to pay. It is practiced when the local market is divided into segments and each segment is charged a separate price. Third, the third degree price discrimination. It takes place when different prices are charged in different markets which are located geographically at a distance, so that transfer of goods by consumers from one market to the other is not worthwhile from the economic sense. Another pricing strategy is the cost plus pricing. It is logical that the price of a commodity should cover the cost of production of the good and also bring a fair amount of profit. Many business enterprises have the idea that the appropriate sales price is the sum of all cost plus the profits, which will yield the target return on capital employed. Under this method, which is also called cost plus pricing or markup pricing, the firm first estimates the average variable cost and adds the average overhead charges to obtain fully allocated average cost. For this, the average cost, the firm adds up a markup, that is M, on cost for earning profits. Let us see an example to calculate cost plus. Let us suppose that a firm has a capacity to produce 1000 units. It uses 75% of its capacity and it is considered to be the standard output. The TVC incurred, TVC, which is the total variable cost, is rupees 1500 and the overhead cost is rupees 750. The markup decided by the firm is 25%. This is generally decided between 0 to 25% of the cost. Therefore, standard output 75% of 1000 is 750 units. Total variable cost is 1500. So the average of it will be the total variable cost divided by the output level, which is rupees 2. Total overhead cost is 750. Calculating the average overhead cost, we need to divide total overhead cost by the output level, which makes it rupee 1. So the total average cost is 2 plus 1, that is 3. Substituting these values calculated in the formula, P, that is price, is equal to cost C multiplied by 1 plus M. M is the markup value. We get the total price as 3 rupees 75 paise. Thank you.